Hi, everyone. I'm Jerry Davidsey, CEO of Presilium Private Wealth. Welcome to Financial Planning Fridays, our weekly video series on financial planning, where we work to simplify wealth management decision-making for our clients so they can focus on what is most important to them. Today, in our 14th episode, we wanted to talk with you about saving for college and the advantages of using a 529 college savings account. College costs are higher than ever and are expected to continue to increase. The average cost of a student living on campus at a four-year private nonprofit university is now $54,501 per year, or $218,004 total over 4 years, according to educationdata.org. They also reported that the average college cost has more than doubled since 2000, with an annual growth rate of 7.1%. If college costs continue to rise at this same rate, then the average four-year private university will cost more than $200,000 per year when children born in 2022 head off to college. The total four-year cost will be almost $900,000. A 529 plan, also known as a qualified tuition plan, is a tax advantage plan that allows you to save for future education costs. There are two types of 529s: prepaid tuition plans and education savings plans. Because they are more common and often more applicable, we are solely going to focus on education saving plans in today's video. A 529 education savings plan allows you to open an investment account to save for your beneficiaries' future qualified higher education expenses. These include tuition, room and board, and other expenses associated with education. More recently, this can also include up to $10,000 per year per beneficiary for tuition at any public, private, or religious elementary or secondary school. And although these contributions are made on an after-tax basis, these plans have a few tax benefits that make them attractive, especially for those with a longer runway to college. Withdrawals used for qualified education expenses are not subject to federal income tax, and in many cases, state income tax either. Many states also offer a state income tax deduction in the years that the contributions are made. In total, you can save up to $16,000 per year per beneficiary in these plans. And for married couples, this means you can contribute $32,000 per year per beneficiary. However, an important consideration if you do decide to make a withdrawal from your 529 plan for something other than a qualified education expense, the earnings will be subject to federal and state income tax, as well as an additional 10% federal tax penalty. But because the contributions went in an after-tax nature, there will be no additional taxes or penalties owed on this portion. To provide additional context for anyone wondering how much they may need to save in order to fully pay for a four-year private school education for a senior graduating today, you would have needed to save roughly $421 per month from the time they were born if the investments had grown at the same rate of return, 9.03%, as the S&P 500 over the past 18 years. If college costs continue to increase like they have, and the returns remain the same as the previous 18 years, then you would need to save about $1,740 per month to get to the projected $900,000 total future four-year cost that we mentioned. In this example, you would contribute about $375,000, and the remaining $525,000 would come from growth and dividends. By using a 529 college savings plan, you could save more than $100,000 in potential tax on these earnings. Please forward this video to a friend who has children or grandchildren and may benefit from this discussion. Also, please feel free to reach out to us anytime to discuss a 529 college savings plan for you and your family. Thank you for joining us today. Have a wonderful weekend, and I look forward to talking with you again soon.